In early 2025, Canada executed a significant shift in its oil export strategy, redirecting a substantial portion of its crude exports from the United States to Asian markets. This move was catalyzed by a combination of factors, including the United States imposing a 25% tariff on Canadian oil imports, the cancellation of the Keystone XL pipeline back in 2021, and the completion of the Trans Mountain Expansion project in May 2024. The TMX, now the most expensive infrastructure project in Canadian history at a staggering 34 billion Canadian dollars, increased pipeline capacity from 300,000 to 890,000 barrels per day. It provided a vital direct route from Alberta's oil sands to British Columbia's Pacific coast, unlocking new access to global markets. The shift quickly gained momentum. By March 2025, China had imported over 7.3 million barrels of oil from the port of Vancouver alone. Canada's heavy crude oil, high in sulfur content, is uniquely compatible with China's advanced refineries, many of which were previously reliant on Middle Eastern suppliers. Those suppliers, while long-standing, have become increasingly expensive and politically unstable. Canadian oil offers not only a cheaper option but also a more geopolitically stable one. This trade relationship is proving to be a game changer. Crude oil imports from Canada to China in 2023 were valued at nearly $3.95 billion, and the total mineral fuels and oils trade reached $6.32 billion, showing clear signs of exponential growth. For Canada, this realignment isn't just about diversifying trade. It's about reclaiming strategic autonomy. For years, Canada served as the United States' most loyal energy partner, delivering over 60% of U.S. oil imports. Alberta alone supplied approximately 4.3 million barrels of oil daily to American refineries, fine-tuned to process the kind of heavy crude that Canada specializes in. But American decisions, like canceling Keystone XL and layering Canadian steel and energy with tariffs, pushed Ottawa to seek alternatives. The Trans Mountain Expansion didn't just add capacity, it symbolized a change in mindset. Canada no longer sees itself as a sidekick in the North American energy equation. It's stepping into a more global, assertive role. As Canada finds new customers across the Pacific, the United States is feeling the squeeze. With the redirected oil flows, U.S. imports from Canada are expected to dip below 3.5 million barrels per day, a significant decline from previous years. This is no minor adjustment, it's a fundamental supply shock for a country where many refineries aren't designed to run on lighter domestic shale oil. The consequences are tangible. Refinery throughput has taken a hit, gasoline prices have surged past $4 per gallon in several regions, and there's growing concern over job losses and energy security vulnerabilities. In response, Washington is scrambling to recalibrate, proposing new drilling incentives, reconsidering some tariffs, and even exploring emergency energy agreements. Meanwhile, other major Asian players are jumping on the opportunity. India, which has seen its energy demand skyrocket over the past decade, is actively negotiating long-term agreements with Canadian producers. Indian refineries are equipped to handle heavy crude, and they're reportedly seeking up to 200,000 barrels per day from Canada. In 2023, India's imports of mineral fuels and oils from Canada reached $2.03 billion, with crude oil accounting for $1.18 billion. Japan is also expressing serious interest, looking to hedge against Middle East instability and secure about 150,000 barrels daily. Though Japan's current crude oil imports from Canada are relatively modest, about $17.6 million in 2023, the growing geopolitical risks in the Middle East have encouraged Tokyo to rethink its energy diversification strategy. This convergence of demand from China, India, and Japan is forming what analysts are calling an informal energy trio. If these partnerships solidify, they could fundamentally shift the flow of global oil trade away from traditional Western-centric models. Canadian oil, once tied almost exclusively to the U.S., is now anchoring Asian energy security. In practical terms, Ports like Vancouver are expanding tanker lanes, oil storage hubs are scaling up, and Pacific trade routes are busier than ever. For Canada, the economic incentives are substantial: more buyers, better pricing autonomy, and a seat at the global energy negotiating table. For Asia, it means reduced exposure to the volatility of the Middle East and a more balanced portfolio of oil sources. But while Canada's pivot east may look like a strategic masterstroke, it's not without serious domestic and global concerns. The Trans Mountain expansion has reignited fierce resistance across the country. Indigenous groups have filed lawsuits challenging the pipeline's expansion through traditional lands, and environmental organizations have organized large-scale protests from Vancouver to Calgary. In British Columbia, court orders have already stalled portions of future extension work. Critics argue that Canada is making a dangerous bet at a time when the global energy narrative is shifting rapidly towards sustainability. In 2024 alone, over 20% of all new car sales were electric vehicles. China, the same country importing millions of barrels of Canadian crude, has set an ambitious target for 50% EV sales by 2030. This raises a critical question: is Canada betting big on oil just as the world is preparing to move on? Global developments further complicate the picture. Rumors in Washington suggest possible regulatory or even sanctions-based responses to Canada's deepening energy ties with China. Some American lawmakers are floating the idea of restricting capital access to Canadian oil firms or tightening oversight on cross-border pipeline activity. Meanwhile, climate policy is tightening globally. Solar energy costs continue to drop, battery technology is rapidly advancing, and green investment funds are pressuring governments to move away from fossil fuels. Canada now finds itself walking a tightrope, leveraging its oil resources while trying not to alienate global investors or long-standing Western allies. At the heart of the debate is a deeper strategic dilemma. On one hand, Canada is capitalizing on what could be oil's final profitable decade, positioning itself as a key supplier in Asia's industrial boom. On the other hand, it risks being caught off guard if the green transition accelerates faster than expected. If global oil demand dips ahead of forecasts, Canada could be left with stranded assets, billions of dollars sunk into infrastructure that no longer pays off. The economic and geopolitical rewards are high, but so are the environmental and diplomatic risks. So where does this leave Canada? In a moment of bold transition, straddling two worlds. It's staking a claim in the fast-changing energy landscape while facing pressure to adapt to a more sustainable future. Whether this pivot turns out to be a strategic masterstroke or a last lap around the fossil fuel track will depend on how well Canada can balance its short-term gains with its long-term responsibilities. The world is watching, the markets are shifting, and the clock is ticking. As the oil flows eastward and the geopolitical tides shift, Canada's gamble sends ripple effects far beyond pipelines and ports. Energy, long treated as a currency of power, is now being redefined by connectivity, resilience, and adaptability. And in that sense, Canada's pivot is a litmus test. Can a major oil exporting nation reconcile the urgency of climate goals with the imperatives of economic opportunity? Can it maintain domestic unity while forging new alliances abroad? These aren't abstract questions, they're playing out in real time on the global stage. For Canadian policymakers, the next steps are critical. They must balance foreign demand with domestic approval, managing the optics and consequences of becoming more entwined with authoritarian states like China. It's not just about who buys the oil, but what that relationship represents. Environmentalists argue that doubling down on fossil fuels undermines Canada's commitments under the Paris Climate Agreement, especially when clean energy solutions are rapidly becoming more viable and affordable. A solar megawatt-hour that cost over $350 in 2009 now costs under $40. Wind and battery tech are catching up fast. If the trend holds, it's not far-fetched to imagine a world where oil's value plunges not because supply vanishes, but because demand evaporates. On the ground, the pressure is mounting. British Columbia's coastline is facing new environmental risks with increased oil tanker traffic, raising fears of spills and ecological damage. Local communities, especially indigenous ones, are caught between promises of economic inclusion and the real threat of cultural and environmental disruption. While government officials highlight job creation, infrastructure investment, and new tax revenue, critics remain skeptical. They argue that any short-term gains may be offset by long-term fallout, especially if oil infrastructure becomes obsolete or contributes to climate volatility. Meanwhile, Canada's growing oil relationship with Asia raises broader questions about democratic values and strategic alignment. Is energy diplomacy just business, or does it come with strings attached? With China's record on human rights, surveillance, and military expansion in the Pacific, critics worry that cozying up economically could lead to political compromises down the road. Already, some Western allies are expressing concern that Canada may be stepping outside the informal consensus of the G7 when it comes to curbing Chinese influence in global markets. Still, the economic argument is powerful. Canada stands to generate billions in export revenue, expand its influence in Asia-Pacific policy forums, and gain leverage in multilateral trade talks. By reducing its dependence on a single customer, namely the US, it's building insulation against geopolitical shocks. And for an industry that supports over 500,000 Canadian jobs directly and indirectly, this shift could be the difference between stagnation and survival during a period of immense global transition. But make no mistake, this is a race against time. The International Energy Agency now projects that global oil demand could peak as early as 2029, just 4 years from now. That gives Canada a narrow window to make its exports count, build strategic reserves, and reinvest in transition technologies. Hydrogen, carbon capture, next-generation renewables, these are the spaces where long-term security may ultimately lie. What Canada does with the capital and clout gained from this oil surge could determine whether it stays relevant in the energy future, or finds itself clinging to a rapidly fading past. So as Canada barrels forward, trading barrels for bargaining power, it's not just laying new pipelines, it's charting a new national identity. One that must navigate economic ambition, environmental stewardship, and international diplomacy all at once. It's a high-stakes balancing act, and the world is watching closely to see how it plays out. Will this bold realignment make Canada a cornerstone of the new energy order? Or will it be remembered as a final flourish before the curtain fell on the age of oil? Either way, history is being written with every shipment leaving the Pacific coast.